Welcome to Chapter 3 of Intro to Finance, Analyzing Financial Statements. Here we'll specifically use ratios to analyze financial statements and analyze companies. We'll be looking at just a preview for you'll look at this at the end of the chapter, but we compare companies in different ways. Usually these ratios result in an answer of whether it's good or bad. The answer is usually it depends. It depends on how the ratio or the result is compared to other companies, and we call that cross-sectional analysis, or benchmarking is the more common industry term, or how we compare to other dates in time, so like previous years, and how we've improved or declined over previous years. So like with Apple, if we were analyzing Apple, with Apple, we might compare Apple to Google, since Apple has their operating system and Google has the biggest competing operating system, the Android system. So we might compare financials between Apple and Google and see how they compete with each other. We also compare to industry, so we might compare both of them to a combined number for the industry, or we compare other years in the same company. So just an idea of what we use that for. Ratio analysis, the other thing we look at is what does it mean? Is it good or bad? Like I said, it depends usually, because we're looking at how does it compare, how has it improved or declined, or how does it compare to other companies. And often an extremely high or low value are not healthy value. We'll see where that comes into play. So Larry the Cable Guy says, what's coming up? We have ratios, DuPont analysis. You'll need to know about growth rates, and then the two type of analysis we just covered. Your textbook does a really good job of covering and the analysis. They use the DPH tree form, and so does this PowerPoint that I'll walk you through for all the example calculations. I will cover just the categories. I'm not going to go through every calculation in detail. You can read that in your text, and also if you'll hit the website for the textbook company, I've given you a link for that in each chapter. But if you look under Chapter 3, there's narrated PowerPoints from the textbook author that explain every ratio and its result, and those are very good. I highly recommend those if you're struggling with any of these. But the hardest thing for you is going to be not calculating, but really determining what good are these things. Because if you don't get that out of this, anybody can add and subtract and divide and multiply numbers. But figuring out what it means is the challenge for you, and it'll help you out a lot down the road if you can figure out the why part, or what does it mean question. Liquidity ratios, just covering the basic categories. Liquidity is really looking at, can we pay our bills or not? Do we have enough current assets to pay our current liabilities? Current assets being like cash, inventory, accounts receivable. Current liabilities being all our bills that are due in less than a year, like utilities, wages, insurance, rent, those kind of costs. So are we solvent or not? The interesting statistic here is that 30% of businesses fail after 1 year, and after 2 years it goes up to 50%. So only half the new businesses will survive after 2 years. A lot of that deals with, are they liquid or not? Can they pay their bills? And those are the ratios, like I said. I'll let you dig into those more. The important thing is to look at, when we look at the analysis, yes, the more current assets we have, like cash, the less liquidity risk we have, the less risk that we can't pay our bills. But the problem is, as you'll see in the third point, those assets, if we have too much, if those ratios are too high, it means we have a lot of cash sitting there doing nothing. You guys know what cash earns right now. Short-term cash earns less than 1%, in interest on it. So, and we could generate a lot more profit by having those invested in the company. So there's risk by not having those funds invested. Okay, so that's an example when there's too high or too high, that could be a problem. Then we go through asset management ratios. The next category deals with how efficiently do we use our assets. Or it says really looks at how do we make more money with what we have. And they're focused on, for example, inventory. we have an inventory management ratio that says how much can we produce, how much in sales or cost of goods sold can we produce off a given level of inventory. And you want to be able to produce as much in sales as you can with the least amount of inventory to be efficient. Because if you're thinking, Walmart is a good example of that. Walmart's almost a just-in-time inventory system. They have stuff coming in every day, and so they hold inventory for a very short amount of time. And that's what you want. Because you have to invest in storage cost and extra record keeping and things like that if you have to store large amounts of inventory. So it just shows that you're more efficient the more times the higher this number is. And the downside, another example of the downside of that measure is you could say, well, you want that to be as high as possible. Well, the downside would be if you're completely just in time, then you have a chance of running out of stuff. And that's a perfect example with Walmart when you get frustrated when they don't have what you want in stock. And it's because their inventory, they hold it they have a very low level of inventory and have it arrive just in time. And just one other note out of this section is our goal with efficiency is we also want to use our cash wisely and have use of our cash for as long as we can. And so we want to take, particularly with this measure, accounts payable, average payment period. We want as long as we can to pay our bills, and we want to collect our money as quickly as possible when we deal with accounts receivable. So collect it as quick as you can and take as long as you can to pay it. Sort of conflicts with each other, but that is a measure of efficiency. Now, debt management ratios, the next category, deals with what's our mix between debt and equity, and how does that affect our return, our long-term return. So, and we'll see how debt affects the bottom line or your income. We really look at debt versus equity financing and the debt to equity ratio, which that tells you just how much debt you're using in comparison to equity. So if you remember, using a lot of debt is called leverage, and we hope to produce more income the more debt we have. Not always the case because it increases risk. Leverage ratios show how we can cover interest costs, the biggest cost with debt, which we want to be able to cover that to lower risk as well. Profitability ratios are looked at by the market, and those just show things that are important to all of us, like profit margin, which shows how much we're earning on every dollar of sales, and that's what all of us should be concerned about. What's our bottom line after all of our expenses on sales? And it gives us that in a percentage term. Two other very important measures are called return on assets and return on equity. Return on assets shows the return, how much money you get back on every dollar that was invested. And return on equity shows how much we get back on every dollar just the owners invest. So it shows the effect of borrowing there, because it's just, we should have a higher result for return on equity than we have on return on assets. Market value ratios are what investors are also concerned about when they value our company. One that you're going to hear about a lot is the price-earnings ratio. It's what investors are willing to pay for every earnings dollar that the company makes. It's the price per share over the earnings per share. You'll see that a lot. The higher that number is, that means the higher potential that investors see in the company. Very important and used quite often in the industry. And DuPont analysis brings everything together like a big machine, and it just shows you, if you change those ratios, how does it affect your return on equity, the bottom line number that's important to everyone. And the last couple of things are just growth rates. How quickly can we grow based on just our retained earnings, and how quickly can we grow and borrow? And those calculations will show that. And then the types of analysis we talked about. And I would recommend looking at the PowerPoints online, the narrated ones from the textbook, and I think you'll be fine if you practice these calculations.